Nervous about the volatility of public markets? Looking to invest in Canadian real estate but not finding the right opportunities? Neighborhood holdings may be an option. Nearly 10 years of consistent performance, Neighborhood aims to provide stable income while preserving invested capital, target net yield above 8%. At the heart of the strategy is Neighborhood's mortgage product portfolio of first position 100% residential mortgages across Canada with an average loan to value under 55%. Neighborhood partners with mortgage brokers and financial institutions to support quality borrowers in transition who may not currently qualify for traditional financing and have a temporary need for capital. Neighborhood's portfolio has no exposure to commercial, construction, or bare land properties, is geographically diversified across major urban and suburban centers in Canada. Check out the links in the description or visit neighborhoodholdings.com to view the offering memorandum for investors and advisors or to explore mortgage broker partnership opportunities. This is not advice. Please consult a professional advisor before investing a loonie in any of these investments. Before we get started, I just want to remind everyone that this information discussed today is not intended to be or construed as investment advice. Please consult a professional advisor before putting a loonie in any of these financial markets.
The dirty secret is that no one's ever going to get paid back.
People have the shortest memories when it comes to investment.
We just got to get Keith into Bitcoin.
Hey, there's a bubble.
Welcome back to Loonie Hour, episode 203. As always, join me the three amigos, Boomer over in Halifax, Rich Diaz, Montreal, back to the art wall.
Back to the art wall, which actually, sadly, this might be the last time. It will be the last time you guys see it. So enjoy while it lasts, because I'm moving this weekend.
To the penthouse.
No, just down the road, actually. Just down the road. I'm like a.
Why are you moving? Like, what's the? Is it like the crazy neighbors in your building?
I'm anticipating a humongous raise, actually, to be honest. No. This was like people, as everybody knows, I lived in Halifax, then London, and then back to Montreal, and then the place I moved is just a little bit. It's not that great, so I found a really nice little spot around the corner, right next to a hockey arena, and so. I will be on a quest to join the Montreal Canadiens in, I'd say, 3 or 4 years after I do a lengthy training session.
The way their roster's shaping up, you might have a chance.
Never give up the dream, Rich.
Thanks.
Keep going for it.
The place is great. It's right next to a park. If you guys, people are familiar, Westmount Park. And it's just a little bit nicer place.
Okay. Boomer, how's the multiplex coming in your neighborhood?
It's a bit of a story. It's turning into a legend.
You got a lot of shadows in the back.
You always talk about, Steve, about you algos get fooled up sometimes when you follow something online. Your algos.
Algos.
Algos?
Algos.
Algos. So on my thread thing now, remember that movie Titanic with Kate Winslet and Leonardo? I'm getting Titanic stuff all the time. And it's actually pretty fun because it was a thriller, it was adventure and some romance too, Rich. Some loving going on.
Oh, there was. I remember that scene.
In the beginning, I'm thinking I got to get rid of this, but now I'm watching it every night. Just little clips.
How the hell did you end up getting that served to you?
I don't know.
Going down the rabbit hole. Anyone that's listening, we have a group chat obviously for the Loonie Hour. This guy sends some weird stuff. So the algo is definitely something's going on with your algo there.
Yeah.
I searched something and it's there, but I don't mind it. That's my point. This one is okay.
You have to hide your For You page for Mrs. Icecap.
I hold it like this so Mrs. Icecap can't see me watching Leo and Kate run around the ship that's sinking. Speaking of sinking ships, maybe we have a good episode today.
Hey, nice segue, Boomer.
Hey, thanks.
Yeah, we got quite a bit going on. We got the we'll kind of go around the horn here. We got the elbows down stuff that's going on in Canada. We got some update from the Fed at Jackson Hole last Friday after our recording. BOC talking about housing affordability and the big theme, which we've been all over really for the last, it's been months now. I mean, we talked about Japan last year. We talked about the UK throughout this year. We had a good guest last week. And effectively is the sovereign debt markets are signaling something very bad in
particularly in France, Japan, and the UK. So we'll kind of get into that as well as some capital flow issues, Rich, in Canada. So quite a bit to jump on, but
I think I know what happened. I was researching Britain and disasters, and that's how the Titanic stuff came up.
they're okay. Now that might work. That might work. Whatever you can tell Mrs. Icecap to convince her. But anyways, Boomer, we talked about, the Canadian election. Obviously, it was elbows up. Mike Myers, incredible ad, ultimately, that worked like a charm. Because the Liberal Party got their outcome that they wanted. Rich, you argued on the show that we didn't have any leverage and the elbows up stuff was never going to work. And we found out last Friday, again, the day after our recording, that Mark Carney has removed all of the counter tariffs on US.
Yeah. Well, I mean, listen, if I remember correctly, I said it was, focusing on Donald Trump, as annoying and as boorish as he might be, and frankly, as ill-advised as some of his trade decisions with respect to Canada are. I thought it was a gift. It was a gift from heaven that the Liberal Party could run on fighting Donald Trump rather than on their dismal record, as evidenced by the data that you can clearly see on StatsCan. And despite all of the emails that I got saying I wasn't patriotic and I wasn't angry enough about the situation, I mean, I thought I had a pretty clear vision of what would go on, which was as soon as they won the election, they would go, they would unwind all that, and I think it's been playing out. And it's not because I'm not patriotic. I absolutely love Canada. I think we have everything to fight for. I just think that we just had no leverage, really, from the off. And I think Mark Carney is demonstrating that. And I just feel bad that a lot of people got played. What is that Mark Twain quote? It's easier to con people than to convince them that they've been conned, or something like that. But anyway, so we'll see.
No, it's great, Rich. I mean, it's crazy to see like the media. Just the force of the media, I find it so fascinating. Obviously, like we're a media company at the Loonie Hour, and just seeing the influence that media can have, and obviously, like, I think on a relative scale, we're a relatively smaller podcast compared to, let's say, the CBC and the Global News that has the reach across the country, but I think like the brainwashing that went on. There was an interesting poll that came out this week from Abacus. So they showed that basically the poll basically highlighted the stark generational differences between, let's say, boomers and the younger generation. So an Abacus poll showed that 55% of Canadians over 45 cited Donald Trump as the top concern in Canada. That was compared to about 18% for those aged 18 to 29. So effectively, what you see in the Abacus poll is basically the younger generation, their top concern is cost of living,
housing,
right? Cost of living, affordability. Like, I can't basically get by. And the boomer generation's top concern is Donald Trump.
So the boomer generation, they have a severe acute Trump derangement syndrome going on. That's what I'm hearing with this. But like with everything, the biggest, I think, if someone could clip this together to put it would be quite funny to watch. All the leaders in Canada, in the election, when they said it was an existential crisis, Canada will not exist if we don't fight this. And it turns out they're all completely wrong. But, people are sheep. They get all worked up over, the most polarizing figure maybe in our lifetime that we have right now. And here we are, cooler heads have now prevailed, 8 months, 9 months later, whatever it's been. And as Rich has pointed out, we're no longer being aggressive towards it. We're going to have to.
Well, I think it's important to clarify that, like, whether it was the Liberal Party or the Conservative Party, they both sort of angled their political campaign towards sort of, Donald Trump and, we're going to fight him. The conservatives sort of put up a tough stance as well. But obviously it was made famous, of course, by the elbows up campaign or quote, which was obviously the Liberal Party there. And it's just ironic to sort of see it come full circle because Rich, you basically argued that like we just don't have. The reality is the economics are going to bear out, which is to say that we don't have the economic leverage to basically enter into a trade war with the United States of America. That was always the point. And so it was always going to have to be effectively elbows down and try to work out some sort of agreement. It's interesting. You're starting to read these articles coming out, in the Globe and Mail this week saying, opinion, Mark Carney had no choice but to go elbows down. All our allies already have. And, there's another one out this week showing Mark Carney's elbows disappear, but he's making the right move in the Toronto Sun.
I mean, honestly, excuse me, pardon my French, fuck those people. Because they were the first ones raising the flag that we need to fight and we didn't need to fight. And I'm sorry to say, I was right about it. I think, and that's not this, by the way, just there's two separate things I think we need to clear. It does not excuse his behavior towards us. I think that's what people, I think, conflate sometimes. Like, just because you think that the reaction was wrong doesn't mean you excuse that behavior. You know what I mean? And I think that, like, Mark Carney should read The Art of War. Like, instead of, baiting Donald Trump into basically a pissing contest, he could have, gone there, flattered the guy, told him what he wanted to hear, and really wound down the rhetoric and turned down the temperature. But he did the exact opposite for political gain, and credit to them. They won the election, right? It worked. And that's exactly what I said at the time. And it happened now. And we'll see the reality that that eventually a deal will be made. And of course, these sycophants will come and tell, and what is it? Seal, like when the seal clap, all the great things that he's doing. But there's another side to this that I think is really important, and we got the data out today, which is the Q2 current account balance data. So that's like trade, so it imports, exports, as well as like the funded flows, and we'll talk about that a bit later. But the damage, there has been damage from Donald Trump. And again, I don't want people to conflate those two things. It's not okay that he's putting those tariffs and behaving that way. It's also was bullshit when Mark Carney said elbows up. Like, and I think we need to keep those two pieces in our head at the same time.
I have a bit of a different view, Rich. I blame I don't blame the Liberal Party or conservatives. That's the strategy they decided to take. Instead, I would go back to the media platforms at the time. The media platforms should have said and recognized, if they'd really done their homework and thought about it, and should have said, wait a second, this is not a big risk to Canada. This is not a threat. These other discussions are more important. The population growth, how much that is completely screwed over our economy in our society. But because the media kept amplifying it all the time, it just energized all the parties who were running to go down that road. So, and of course, people who accepted it, and they're being fed this stuff. Come on, guys, think for yourself. Follow the Loonie Hour. We'll tell you what's really happening. Stuff like that.
Just like,
anyway,
let's not
live to pass.
It was a legitimate threat, though. I mean, it was a legitimate threat. It was more just, again, like Rich, we joked about it like off the air, which is to say that like if the United States wanted Canada, they'd invade and have us conquered in a day.
Yeah, not a shot would be fired, and that's the point. The threat wasn't.
It wasn't a legitimate threat.
It wasn't a credible thing. He was obviously trolling a guy that he hated in Justin Trudeau. And I think that like what disappoints me is that like Canadians need to stand up for themselves, not elbows up, but our whole identity cannot be about hating America, right? Like we need to figure out what our values are and what our principles are. And when a bully comes out and says something as asinine as we're the 51st state, a country that has confidence in itself would just shrug it off.
All right, now that we've lost half of our audience, the political stuff, let's shift gears to what the younger generation is ultimately the most concerned about, which is affordability, cost of living, And so we had the Bank of Canada out. Funny enough, this week, there was an article in the Financial Post saying that the Bank of Canada says housing affordability is to become more of a focus in its next mandate review. Cost of housing affects inflation, says the governor, Tiff Macklem, in a speech in Mexico. And he says effectively that housing is a big part of the consumer price index in Canada, so the cost of living affects inflation. Therefore, it is worth examining how monetary policy affects housing sector dynamics and how to best factor housing affordability into our focus on overall price stability. So, Rich, just to clarify, they've effectively ignored the role of monetary policy impacting house prices for the last several decades, and they're now coming to the realization that maybe
So
monetary
Boomer
policy
Terror, these hand up with a question, of course. And did they actually announce that? That's what they said.
that's quote for quote.
It's on their website.
This was in Mexico.
No, he gave a
said?
speech. It was a speech.
It was a speech in Mexico City, I believe.
Yeah.
No way. He was at Senior Frogs dancing on the table in Cancun when he said that. Come on, that can't be real. That's horrible. That's really bad to say that. Because it implies they
why?
never considered it. Because it implies they haven't even considered it before.
Oh, I see what you're saying.
Well,
Well, that's what you said as well, Steve. Did you take that?
every time that the reporter has asked them, I remember during the lead up in the boom, right? When house prices were going up 25% per year on a national basis, the reporters would come into the room and say, hey, what's going on in the housing market? Like, maybe your zero interest rate policy could be impacting. They said, we don't factor in house prices into that's not part of our mandate. House prices are not our mandate. We just don't have enough housing. We need to build more housing. That was like the response from Tiff Macklem at the BOC throughout the runaway house price gains of 2020 to 2022.
Wouldn't it be great if the Loonie Hour, made up the Monetary Policy Committee?
Well, I'll settle for a press pass.
If anyone is able to do that out there, please help us get a press pass. And we guarantee the questions will be a lot more interesting than what's coming out now.
But what's funny is actually it echoes what I was living in the UK at the time, and I spent much more time looking at the UK economy, and I was following Mark Carney, who was the governor at the time. And somebody asked a similar question in 2016. They said, is the ease of monetary policy affecting the house prices in UK? And Mark Carney's like, no, it's supply. And then in 2019, a bunch of PhDs did a bunch of work on the housing bubble in the UK, and they're like, no, it was definitely the financialization of the not the financial, but the ease monetary policy that contributed a lot to the house price increase. So it's interesting that it's a little coming full circle now.
So, anyways, they do not factor in house prices into the Bank of Canada's inflation metrics. And I think ultimately, Rich, when you tell a nation that they should go out and borrow money because rates are going to be low for a very, very long time, monetary policy has a major impact on house prices. And I think you had the really good chart just showing this decade plus of negative real interest rates and the influence that had on asset prices such as real estate that are highly tied and correlated to the cost of borrowing.
Yeah. I mean, it's something I've argued about for a long time. I'm really not a fan of negative real interest rates. And we'll see. I mean, we can't, I mean, in some ways we should be critical that they maybe didn't incorporate it, but let's applaud them for shifting gears. I don't know. Right?
I don't think they're actually going to shift gears, by the way, but
okay, fine.
I think it made a good headline.
What do you mean shifting gears, though? Do you mean they're going to
what are they actually
cutting or raising? Like, what do you mean, though, from that perspective?
Well, I mean, Keith, what are they really going to do? They're going to put like a house price target in their future mandate to say, hey, if house prices are up 10%, we will automatically raise rates. Like, I mean, no central bank to date, to my knowledge, has done that.
Well, they can't do that. That would be nuts. There could be a bunch of other factors that affect housing, like population growth.
Right. So, I mean, I think they talk about it, and the conclusion is going to be, at their next mandate sort of renewal, it's going to be, oh, okay, yeah, we still have an inflation target of 2% with plus or minus 1% target, and we seek to maximize the labor market. Like, I mean, what are they really going to change? Let's be honest.
I mean, I read the speech, and could we be misinterpreting his focus, which is like, 38% of core is shelter. And you've made the point, and I think rightly so, Steve, that there's too much of core is impacted by mortgage interest rate costs or rental or home ownership costs and etc. And maybe they're saying, well, actually, inflation might be lower and interest rates should be lower. I mean, I don't know. It wasn't really clear which exactly direction you could go from the speech. Maybe I need to reread it, but
I don't know. I think that all these policymakers like CMHC, and now we had the PBO, the Parliamentary Budget Officer, coming out with all these like reports of like these economists that sit in these back rooms and pontificate about like what's impacting housing, and how much housing we need to build to get back to this like equilibrium. I think it's all BS. I think the biggest driver is it's a monetary debasement that's been supercharged over the last 10 plus years. Zero interest rate policy, I think, is the largest lever to pull. And then, Rich, I think you can layer on probably the second largest impact, I would argue, is like rampant immigration growth, where you just can't build enough housing quick enough, fast enough to accommodate those people. And I think what you're now seeing is like rates went way up. So we got rid of that cancer, and you slowed immigration effectively to zero. You got rid of that. And now we're seeing, okay, wow, house prices are coming down. They're down 18% nationally. Rents are down 5 to 10% across the country. Vacancy rates are rising. You have record housing completions coming on board because all the housing that we started during the frenzy is now completing as sort of the bubble has deflated. And it's basically just now oversupplying the market at a time when everything is kind of depressed already. And so that's just compounding on it. So I just think like, you put out all these projections about like how many millions of houses need to build. And I think so much is just a factor of just this monetary debasement and horrible policy.
Well, I think it's, it is an imperfect science to be.
Yeah, it's impossible. I mean, how much of it was illicit funds coming from China and the narco network that Sam Cooper has talked about, and like you trying to like put those into a calculator.
The population growth story. I don't think we can stress enough how severe of a policy error that was, because it's affected every part of our life in Canada. Healthcare, again, like people cannot find doctors because of this, because there's so many people here looking for it. And then, so in the monetary policy world, they lived in a world where, their little or their big lever was always had the most impact on everything. I would argue that it no longer had the biggest impact. However, when we did have the huge demand for housing increasing and supply was inelastic, which means you can't rapidly increase supply of your bills, all of a sudden when they do put rates to zero and they cut it, it's just putting even more fuel on top of the fire and more fuel on top of that again. And now we've come through the other side. And again, I find it ironic now to say, well, now we're going to study the impact on it. You can study it all you want, guys. But if you really want to see what's going to change this inflationary story in Canada, it does come down to the population growth story, which I think there was some data this week. Maybe Rich can hit it in a little bit or something. But again, I just don't think the interest rate lever has had a much of a significant impact on Canada as the population growth story. And that's been minimized. But now that should be taken care of. Now we'll go back to more of an importance point. By the way, they're going to go to zero again, everyone.
No, please.
And
no.
They're going to zero. Like the lever, they're not going to move it forward to go. Well, you know what I mean. They're not going to raise rates. They're going to zero. They're doing QE again. All of that. It's It's coming right down the road.
Well, wait a second. I think there's two separate things, though. I think that there was the housing bubble that was sort of created like 10 years ago that was kicked off by the super low interest rates, because the population growth stuff is only the last like few years. And to prove that, I would actually submit to you the Monetary Policy Report of July 2024, which is on the Central Bank of Canada's website. And you can literally see housing demand versus housing supply. And they talk about it themselves. And this was almost exactly a year ago. So don't take our word for it, take their word for it. But I think there's two kind of, and Steve will correct me if I'm wrong, there's two chunks of housing bubble that we saw. One was the interest rate game, and then the second half or the third period was the population game.
Yes.
I think that's fair. I would say, though, that everyone in the GTA today who may be overexposed because of the condo story that's developing, or crisis, whatever you want to call it. I mean, that's a recent phenomenon. So like the last 2 years, maybe, Steve, does that make sense?
In terms of like the excess condos?
Yeah.
But because I mean, I think a lot of that construction of condos was spurred by zero interest rate policy, right? It's like so much of the malinvestment that we're now seeing in the world today, like whether it be, a lot of the solar farms and wind farms that aren't viable, no longer at zero interest rate policy. I think it's same as like housing. It's like it spurred all these investors to flood into the market where everybody's like, I got to build out a condo portfolio and basically just collect rents off everybody because it's the only way to make money in this country.
And you need the population growth as well. So you can have rates at 0% or say 1%. I'm not going to borrow at 1% if I'm going to lose money on my investment. And if rates are at 20%, would I borrow at 20 if I know I'm going to double my money by investing it? Yeah, absolutely, I will. Yeah. So it's a combination of both things happening.
Agreed.
And I just think now we're coming out this other side that it's going to look a lot different.
So just to kind of round this all out, there was a really good chart that went around. I actually had pulled up the US data and I kind of asked if anyone on Twitter had it. So it looks like Twitter pulled through. And effectively, the question was, in Canada, you're married and own a home by 30 years old in this country. So basically a chart showing historical of married and own a home by 30 years old in Canada. So in the 1960s, that number was 58%, dropped down to 52% in the 70s. In the 2000s, it was 32%. Today, it sits at 15%.
Okay.
So married and own a home by 30 years old in Canada, 15% of the population today.
It tells me that people are getting smart and you don't want to get tied to an anchor.
It's one way to look at it.
Is the anchor the home or the spouse? Yeah, you guys decide. That's
maybe both.
Yeah.
I think. But
I call Mrs. Ice. I call Mrs. Ice Cap the old ball and chain sometimes.
She doesn't listen to this.
Thankfully, she doesn't. Listen
she doesn't follow the show at all.
She's the one leaving all the 1-star reviews.
Yeah, that's right.
But yeah, I mean, I think it just comes full circle to like our earlier conversation, right? 30 married to own a home, 15% of the population. It's kind of your social contract has been broken. And it's always funny when you then go back and you look at the Abacus polling that we talked about, showing like what the boomer generation is most concerned about in this country, Donald Trump versus, again, your younger generation, which is like, dude, I can't even, like, I can barely put food on the table.
Okay,
and
but wait a second.
I have no future. Like,
sorry, I didn't mean to interrupt.
Yeah, I just think, and Rich, a lot of that, of course, was supercharged by, I think, probably you've talked about, I think the worst policy error in many, many decades, which was the immigration file over the last 5 years, was just a total tragedy.
I think though, but with respect to like married and having a house, I think there's a couple of factors we have to think about. One, you stay in school for a lot longer. Two, women are in the workforce, so their opportunity cost of having a baby has gone up a lot. Back in the 60s, you might not be educated and a fancy lawyer. In 2020, a woman ostensibly could run many different companies and have so that's affecting, like the fact that, having birth control the number of partners, it probably impacts that. The social pressures have declined with respect to marriage and housing. So I think there's a lot of
No,
factors.
yeah, I think that those are really good, like important nuances. I think that which
sure there's others.
ultimately comes home right to what you're seeing around the world, which is like birth rates just plummeting, not just in Canada but everywhere.
Yeah.
And is ultimately sowing the seeds for population declines. I mean, without immigration, Canada would be enduring population declines as well. I think deaths are now outpacing births in Canada.
Yeah. That's not to say, but that's not to discount your broader point, which is because people can't afford homes, they're less likely to get married and have children. I get that, and I definitely agree with that. But I just think it's important to like keep the other little factors like in the back of your mind as well.
So Keith, this actually brings us to the next point of conversation, which is like what we're seeing in the world today is a lot of similar trends. So Canada's not on its own. But a similar trend that's happening is effectively like the populations are aging. There are, again, in most developing markets, you're seeing more deaths than births. You're now relying on immigration. There's been a lot of pushback on immigration because I think it's been so excessive in many Western societies over the last number of years. And this is causing a lot of political friction, but it's also causing a lot of friction in government bond markets, where you're just struggling to derive real growth and productivity. And again, with population growth slowing dramatically, there's just more and more entitlements that these governments have to pay out. And there's just not enough, basically, new dollars being generated to support the aging class. And so what we're seeing now, as we've talked about with our guests last week, is the crisis that's developing in the UK. And now we're hearing of it in France. And of course, Japan, we've talked about as well. But there was 2 articles this week, basically like back to back. It's funny, I posted them in our group chat there. One saying France may need IMF bailout, warns their own finance minister. At the same time, we heard that the UK is heading towards an IMF bailout. These are like front page news headlines in major publications. So the IMF apparently is going to bail everybody out.
Yes. But back a little quick comment about the whole, the demographic story. It is deteriorating for the West. Think of it that way. So on the face of it, you can understand why you need a positive net inflow of immigrants coming into the country, because they got to pay for the old people. They're getting older. That's happening. The flow of that maybe needs to really be discussed. But if you look at Japan, Rich, what is there? I think there's numbers for Japan.
Yeah.
What are they doing with net immigration?
Zero.
Yeah,
there's zero unless you're a baseball player.
Yeah, I don't think those guys are looking to make it to the Japanese big leagues. They're trying to stay in the MLB. But my point is that
Japan's population is outright declining. It's shrinking.
Yeah, it's been declining for, off the top of my head, at least 10 years. You'll forgive me while I quickly look that up. Yeah.
But what's interesting on the housing front, from what I gather, is that basically all sort of like the rural, far-flung suburban housing markets are like, prices just continue to decline because there's nobody, basically they're all dying off. But you're still seeing price growth in like the inner cities. Basically, people are flocking and moving back into like the major cities of Japan. But I think it's a very interesting lesson that I think Japan is.
Well, because they need healthcare and stuff like that. So like Japan is slowly eating itself that way. And so that's why the West, they're trying, hey, the only way we can change this, because you're not having the natural birth rate, because you need 2 for every woman, basically, to maintain the population. And that's not happening. So yeah, that stuff, again, it's just fascinating, but demographics are the most guaranteed slow fuse to watch burn. and Japan is one with trouble. But Steve, we always joke about how the Loonie Hour is ahead of the curve with different stories, and I think we have been for a lot of things. Sometimes we say we might be early, but we're not wrong, and we have been floating or suggesting that Britain might be the first one that could experience some kind of credit or liquidity crisis. And all of a sudden, out of the blue, yeah, it's starting to happen there. And, for one of the main papers in the UK to come out with that title that, hey, Britain might need an IMF, International Monetary Fund bailout, it's alarming. And it's also a bit funny as well. You have to chuckle because just for everyone who's listening, it is impossible for the IMF to bail out Britain.
Why?
Because they're not big enough to do it. They're not able.
Can you
to
just give
raise...
Keith? Can you give like some background context for our listeners that maybe are less familiar with the IMF, who they are, what they stand for?
Yeah. So the real quick story: the IMF was created at Bretton Woods after World War II. So was the World Bank. And
International Monetary Fund.
International Monetary Fund. And it was agreed that the Europeans would run the IMF and the Americans would run the World Bank. They both do kind of the same things, really. But the IMF is there if any country needs help in that they can't borrow from the open market, or if they can borrow, it's out this outrageous amount of interest they have to pay, then the IMF will step in and say, okay, we're going to help you. And the way they help you, the IMF, they have to take money from the IMF members. And there are a lot of countries. I think almost every major country is a member of the IMF. So they all will have to contribute to it. The IMF would directly issue a bond. So they would borrow money based on the guarantee of the other countries. And then they would say to Britain, okay, we're going to, for example, if Britain needed a bailout, I imagine it would be at least 500 billion. And I say that because the Greeks needed around 250-ish, I think, 240.
Sounds about right.
Yeah, in that range,
But the UK economy is much bigger than the Greek economy.
Yeah, of course. And the financial system, it completely dwarfs it as well. So if the Brits did need a bailout, the financial system goes, whoa, it just topples over because you pull your money out and they're all levered entities. So it's just, it will not be a pleasant experience for people who are not prepared for it. Wink, hey?
Yeah.
But the bailout will go like this. The IMF would say, okay, Britain, we will give you, say it's 600 billion in loans. And there's a lot of conditions attached to those loans. It's not free money.
Yeah.
We're going to give you this money and we're going to give it to you by piecemeal. And the first thing you're going to do is austerity. You're going to cut your spending in half or by a third. You're going to raise taxes and all this stuff. So it's, the currency gets absolutely clobbered, of course, in this scenario. But it's meant as a way to bring them back to fiscal health. And there's some irony with this, of course, because if Britain today, if they cut their spending, say they try to issue a balanced budget next week, that's what happened, I think, with the Liz Truss government, I think, Rich. They try to do a bit of austerity play and they got hammered. But again, you get this money from the IMF members. The reason I say they can't bail out Britain, if this happened in Britain, the global yield curve is contagious. It's not like it just stays within the borders of the English Channel and all that stuff. It immediately goes all over the world. So all of a sudden, anyone else who might be just maybe on the ledge of might needing some help, this is where the French story comes in, of course, all of a sudden, boom, they won't be able to borrow either. Because the yield curve forces in. And all of a sudden, then the IMF are thinking, okay, 600 for the Brits. What would the French be, Rich? Another 600, I'm guessing.
I mean, I actually think you're being really conservative. I think it'd be much bigger, but yeah.
So let's say we're at, 6 plus 6 is 1.5 trillion now at this point. Think of it that way.
Yeah.
And then, all of a sudden, stand on guard for we get absolutely screwed in this scenario. Yeah. Canada's there. And this is when you get that crisis developing. But again, we've talked about this now for a while. We suggested we could get closer to it. We've started seeing the data points move in those direction. I know we've been talking about the bond yields, what's been happening, but to have a major media platform come out within a week, I think, to suggest the Brits might need an IMF bailout. And now, and by the way, the reason the French is suggesting they might need an IMF bailout, because I think they're going to have a non-confidence vote in the government September the 8th, I think it is. So it's likely the current government will collapse in that from that vote. And then Macron will try to recommend a new prime minister, and that will get voted down. It's all a mess, guys. But the reason it's a mess is because everyone's deficit is out of control, rates are going higher, and everyone's increasingly more exposed to more and more debt payments, more and more interest expense payments. So this is from our side, insensitive investment managers. This is exciting now. If you're an investment manager, you're not excited by seeing these headlines, you should become a realtor or something. Because this is
Keith.
This is gonna be fun. This is
Keith,
gonna be fun days coming up.
My question is, so some people, some of our more astute listeners, or older ones anyway, will say that hasn't the IMF bailed out the UK before, and what makes it this time different? Quickly, come on.
Was that a rhetorical? I guess the answer is no, they haven't.
I mean, I know
IMF
the
didn't
answer.
exist.
I'm
No, it's the 70s. Did in the 70s they got
yeah,
some help then?
1976.
Yeah, and is it different this time?
Yeah.
Yeah,
Because
of course
it
is.
worked in the 1976, kind of. I mean, you had a collapse in the pound, you had major issues on the spending side, but what makes this time a bit different?
Is that no one else is aligned, synchronized at the same time is what they were experiencing. That's my view. What is
Okay.
your answer? You sound like you have the answer.
No, I mean,
Oh.
that's no, I was genuinely curious. I mean, about what you were going to say. The fact that the global risk is synchronized today in a way that it might have not been 1976 is an answer I wasn't expecting, but I think that is the right one, actually, to be honest.
So the interesting now is, let's just say the French and the Brits, they go into a moment within the next month. Here in Canada, if I'm advising Ottawa now, I don't care if you're in a red shirt or a blue shirt, and the French and the Brit story is developing, and it's getting nasty out there, I would say to whoever's going to do this, I would not release a budget.
Ever again?
Well, not yet. I would delay it because it's not going to be nice in the So if we have a crisis already developing in Europe with this, and the Canadians come out with this, something that looks kind of nice and everything, but yet by this time, the global financial system, everyone is acutely aware. You're now awake. You're looking around for stuff, and they turn past page 3 of the budget. That's where you start getting into some of the good stuff. I think Canada will just fall right in line with it. So I would encourage everyone in Ottawa is listening, do not release the budget if the French and the Brits are in trouble.
Maybe we do have to give Carney some creds. No budget, no problem.
That's the new slogan, right?
No, it'll balance itself. No budget, no problem.
Yeah. But Rich, why don't you share though because you've spent some time over in London, of course.
Yeah.
I assume you might have a friend left over there, maybe.
Yeah, I do. 1 or 2. Yeah.
Yeah. Did they even talk about that article, or is it? I mean, we know from having Leon Halligan on there a couple of weeks ago, he was stressing this is a big deal, and now that it's coming out.
I guess the problem is my friends are like exclusively in the financial sector. My friends and mentors, I'm still friends with my old bosses, and we talk about it. And I think that they've fundamentally.
Can I ask you a question, Rich?
Yeah, go for it.
Sorry to interrupt you. Like your bosses, who are obviously higher net worth, are they trying to get capital out, or at least hedge some of the risk there?
That's an excellent question. I think for them, I would say the easy answer is no. And I think that they have a lot of U.S. stocks, right? So that's one way that they're in effect already hedged, right? If you own a stock in a different currency and your currency falls, then you sort of avoid that decline. But they're not going to move their money wholesale, if that makes any sense. Like,
I'm just curious if you slowly start sprinkling like some assets out.
They've done that for years, though. They would have done that.
Maybe I go buy some real estate in,
US.
Spain or Portugal or whatever,
I'll have to double check that. I don't, to be honest, I don't know for sure. I just know that they have an equity allocation that's outside of the UK, because the UK.
But I have some UK friends, and there's a couple of them are 10 figures. They're at that level, and like most of their assets, like it's not in. It's not like an investment portfolio.
Right.
They have that, of course, but like they're big assets. Like they would own very nice estates in the UK, more real nice estates in Australia, Sao Paulo and stuff like that, which is illiquid stuff if you think about it, Steve. Like it's hard to do. So for those big wealthy guys, when they look at this, and again, like I have these conversations with these guys, and they're like, yeah, if it happens there, they can see how it would move around. And a lot of them, they're saying, well, I can't touch 80% of my assets. Like they can't move it. So they move around on the fringe. That's what they would do. But someone in say, and this might sound whichever way it is, but someone like with, I can say that 10 to 50 million range you're in there. And maybe they have 30 mil in a financial portfolio. And I can see them doing some things on the edges with it. But they need to be scared first. They need to get that first scare.
Yeah. So just let me quickly say, like, I think I know my boss's brother has moved away. He moved to a different country. They see the writing on the wall with respect to taxes. I think and the very specific ideology that this particular government has. And whereas my younger friends who are also in the financial sector, they're actually thinking about moving to Canada. But that's more for family reasons. So I don't know. I think the problem, I would argue full stop that people generally have an enormous home bias. During the Greek crisis, yes, a bunch of people moved to, London or New York or parts of Spain, but the population fell a little bit, but still 8 million people there. And same in Portugal and same in Spain when you had the crisis in the euro area in 2015 and 16. So I think on the margin, I think you get a bunch of wealthy people leaving. And in fact, in the FT just a couple of weeks ago, they had a chart. I don't know if we can verify this, but they basically had a list of all the countries in the world and the net change of millionaires moving in and out. And the two countries at the top of the list with the most amount of millionaires leaving were UK and China, which I thought was fascinating. So I guess, maybe that's a better way of answering the question.
But Rich, go ahead, Keith.
Yeah, it's just interesting, right? And I think, the next step to this, it has to be now like a sharp trigger point in the market. And then all of a sudden, more and more people are discussing it, and we see. But I think now we're in the second inning, a while back, and then I think now this is ratcheted, not innings, but it's ratcheted up a little bit more on the alert scale. So let's follow this. But the next big event, though, will be that French confidence vote that's coming up on the 8th.
But
that
Rich,
will have a big impact.
You've been flagging the long end of the curve for many of these sovereign debt markets. And so maybe kind of walk us through what you're seeing there.
Well, it's just that we talk a lot about there's different parts of the yield curve. And when Steve says the long end, so there's like the short end, the long end, naturally. So that basically refers to the maturities of bonds, very, very simply. The front end of the curve, really short-term maturity, will reflect monetary policy of central bank. That makes sense. That's the part they literally have control over. And in the long end of the curve, it includes a bunch of stuff. I'm going to narrow it way, way down to include things like an inflation expectation, a growth expectation, and let's say a term premium, literally how much you pay for the extra year that you knock onto the bond. And what we're seeing basically across the long end of the curve is, despite the worries about growth, despite the fact that central banks are saying, basically telegraphing that they're going to cut rates, that the long end of the curve is not only not falling, which is what you might normally get in a world where you have less growth, which means less inflation and worries about other assets, is that the yield curve at the long end is actually rising. So you're getting the term premium component, which is a kind of an ephemeral modeled piece, is rising. The inflation component is rising, and even though the growth piece is really sort of anchored, right? Because everybody's worried about growth. And so that to me is where these problems come up. And it's happening in Japan, which is the 30-year hit a series high, Steve. I don't know, like literally almost an all-time high. It's happening in France, UK, it's happening, and in Canada. If we're not at the all like 30 or 25-year high in the 10 and the 30-year bond yield. Now, people might say, Rich, there's not that much 30-year paper out there. So, okay, fine. What about what's going on in the 10-year world? And again, it's the same thing. The 10-year bond yields refuse to fall, even though we're in a world of weak growth, et cetera, et cetera. And so that's just like, should be a massive, massive red flag, and is why you're getting articles about these bailouts, because deficits are not coming up, or, deficits are still really strong. You have all this debt that needs to be rolled over, and the bond yield's not playing ball. People who are buying this paper want to be compensated more and more because they don't trust basically they're going to get paid back in real terms. Ultimately, that's really what it's about. It's actually what I say at the beginning of the intro for the Loonie Hour. And one of our Loonie Hour listeners flagged that on Twitter.
Which is interesting, right? Because like I think we've been trained and taught, and we joked about this last week, but like, the 60-40 portfolio, right? I mean, you should have 60% of your portfolio in bonds, and obviously how much of that then is made up of, let's say, the long end of the curve or the short end. And now we got Vanguard saying, you should have 70% bonds, which is interesting considering all the sovereign debt issues that we've been talking about. And so maybe there's a difference of opinions there. But Rich, if you were to take this back to sort of Canadians, like what is happening sort of in maybe, let's say, the belly of the curve or the shorter end of the curve? Like I always look at it and say, like, for most Canadians that are listening to this podcast, they might not be, bond experts, and they might not even have that much care for the bond market, which is totally fine. But I think a lot of Canadians, 70% of Canadians own a home and will typically have a mortgage. And so this can obviously impact mortgage rates.
But that's what's so fascinating about what's going on right now, is that even the 5-year bond yield is right now at 2.96 or 2 whatever it is, like, so let's say 2.95, just say, that's not coming down either. And so and the reason, in my view, is because I think there is a major bubbling skepticism about whether or not these central bankers are doing the right thing by cutting in the face of rising inflation, B, the massive debt issuance that we're seeing, and that's what a deficit is. You have to issue more paper. And then C, the fact that in Canada specifically, you have 553 or whatever it is billion dollars that will need to be reissued between today, the end of this year, and all of next year. And then what that means is, so more debt issued at higher interest rates means higher debt charges added to the more deficit. And so the bond yield is telling you that something's wrong. Like, so something does not square. Remember, in the face of weaker growth, right? Normally, when you like when you read your CFA textbook, you say, well, what if you're going into a recession, bond yields fall because there's weak growth, and you shift your allocation from a high growth asset, which is stocks, to a low growth asset, which is bonds. But even in a world where you have a weaker growth, those bond yields are not sort of quote unquote cooperating as they should. And so to me, this is we should be thinking about this. Sorry, we have been talking about it for a year now. I think this will continue to play out.
I just want to emphasize the point you just made, because I think this is what I've talked about and tried to emphasize to anyone that would listen, is I think this is the number one mistake that I saw with most home sellers this year, was coming in from 24 into 25. Every single person just kept reading the Globe and Mail article headline, which is to say, oh, big bank forecasts that Bank of Canada will lower rates, whatever, 4 times this year in 2025. And so everybody just assumed that, oh, Bank of Canada lower rates, which means lower mortgage rates across the board for everybody, which means house prices back up. And as we've tried to emphasize, listen, like the Bank of Canada can cut rates and influence the variable side, but maybe your fixed rates don't move at all, and maybe they actually move higher. And what we've seen this year is there's been no change in basically fixed rates from January 1 to today. I mean, they've effectively been flat throughout the entire year. And maybe this is as good as it gets for the next little while.
I mean,
and maybe they even go higher potentially next year.
It very well could. It very, very well could. Especially, we don't even know what this like big, beautiful budget deficit's going to be. And and again, what if inflation, the Monetary Policy Report of July, they said inflation was sticky. They used 2 measures. One, core, right, their preferred measure, and then they also use inflation breadth. Both of those were, and then we're front running our Loonie Hour episode from 2 weeks from now. They're going to cut into that. Okay, interesting. We'll see how it works. And then again, add on to the budget deficit, add on all the refinancing. So I think it's fascinating. And by the way, just to answer your question quickly, it's almost literally a year ago. It was the 5-year bond yield was exactly the same as it is now.
And the labor market's been deteriorating throughout.
Yeah. So
sorry, Steve, I wasn't listening to what you said.
This guy's sitting over there with no mortgage.
So let's sort of, I guess from our perspective, and I say this a lot, you're always looking for little clues, what's happening with the financial world, what's happening, are we moving in that same direction we thought? Has it changed? And with Rich, with you identifying that, long-term rates are either going higher or they're not going lower, right, at the exact same moment in time when overnight rates are going lower, economies are slowing, maybe there are job losses or maybe there are not, depending on how they want to count them around the world. I mean, that should be a huge amber light, or like some kind of alert thing should be coming on with everyone with their financial mind to say, hey, something is happening here. And I like to say that the crisis that we're heading into, because in financial markets, you leave one crisis, you react to it with different monetary and fiscal policies, which always sow the seeds for the next crisis. That's just the way it works. And we believe this next crisis that's coming up is going to be incredibly different, because it's going to be from the public sector, which is the bond market, which is the biggest market in the world. And so far, all the clues we're seeing, it continues to point that way. So by the way, if the UK or if Britain has this kind of crisis moment, and if the currency gets clobbered and the bond market gets clobbered, what happens with the stock market?
Probably goes up.
Oh yeah, it's going to scream higher, like that. And people sitting down, you're going to say, "Well, that makes no sense." That's the way money moves around the world. So if you get, I expect we can see an experience. Yes, Steve.
Do you think part of that is maybe an element of what's happening today in like the U.S. equity market, which is to say, like, valuations, I mean, just keep moving higher, equity markets screaming higher. And, what we're seeing out of the US is effectively, listen, Treasury Department saying we're going to issue more, effectively, they're going to issue more short-term paper. And they're trying to get the Fed to cut rates to basically help finance all this debt issuance they want to basically finance at the short end, as opposed to, putting it out on the long end of the curve. So it's like, you're kind of like, effectively, the U.S. government is trying to basically run the central bank.
Yeah, I agree. And I think the same thing will happen in Canada. So when, that budget that I'm not going to release, but we're still borrowing, they're going to, finance that on the short end of the curve.
Right.
'Cause I'd much rather pay 2% to borrow than 3 or 4. I mean, that's going to happen.
You know,
And
you
that's gonna,
borrow all your money in the short end and you control the Fed. I mean, you know, we were firing Fed chair officials and telling Powell he needs to quit and resign. And
yeah, and I'm just saying it's not just the Americans that are doing it.
yeah,
Everyone is going to roll down the curve and issue on the short end. But with equity markets at all-time highs, gold hanging around at all-time highs, crypto doing the crypto thing, again, it's all suggesting things are not great in the world. And people don't see it that way, of course. They think, oh, things must be awesome. If you
yeah.
have private markets going in that direction and the bond market sort of saying, hey, something's a bit off here, this is what should catch your attention. But yet, we will always live in a world where people will identify more with the name of their favorite stock than where the 10-year is, or the term premium, or all these other things that Rich says to bore us to death. But they are more important than the name of your favorite AI stock and everything. They really
Is it
are.
safe
We're
to say
we're,
that people,
we're headed for something. And I do think we come back to work on Tuesday. Labor Day is over, and all that. Summer is then over. You're gonna see things just come on fire again. I don't mean from a bad perspective or good. Everyone's going to be on alert starting on Tuesday. You're going to see an entirely different narrative than we have over the last few weeks.
you got
There's
everybody
just
exciting, but is it safe to say that, people aren't necessarily worried about their risk assets? They're worried about their risk-free assets.
The average Joe?
Not the average Joe, but I mean, almost if you're like a relatively large money manager, financial institution.
I the answer is for people who
Like your risk-free
benchmark.
asset. I mean, you have to be. Do you not start getting worried about that? I mean,
Well, I think people who benchmark, and that's what most funds do, they don't care. They just make a relative decision with it. So for most, if you're in a mutual fund or something like that, and if the market is down 30 and you're down 25, you hit a home run.
bonus, please.
Yeah, bonus, please. Yeah, I'm going to be ranked in the top fund in Canada because I lost 25% of the assets. It's the
Keith, you
managers.
outperformed. Keith, you
Yeah,
outperformed.
outperformed. Yeah, but outperformance matters in that world. But for the average person, with this, if you're older than 30, you do have a spouse and a house, all that stuff. No,
A
but
mouse.
if you are an individual, you don't care about a relative return. You just don't want to lose the value of your hard-earned savings. So yeah, so Steve, so these funds, people call them hedge funds, but really money that's not linked directly to some target they have to outperform. Yeah, they're already looking at this stuff. That they are. And they're trying to figure out, okay, where do we put our money next, and so forth. So like one of the data points that we look at a lot is it's the commitment of traders report. So COT, you see that. And so that's from the futures market, and you can go into any market you want, and you can see how people are positioned. And if people are way over on one side of the boat, it doesn't matter what's happening in the world. Chances are they're going to start moving to the other side, and it sort of rights the ship a little bit. But which market? Rich, this week I think you shared one. Was it the? I don't remember which market. Was it the oil market? I think was it crude oil that we
Oh, I
saw.
think it might have been commodities. Just
you're
more
talking about
generally.
commodities, Rich.
Yeah, I think I was talking about the
And that was
commodities.
a different chart as
Oh.
well. Yeah. Yeah, absolutely. But you're getting these things happening, Steve. So we're getting extremes on all ends. And people who are not, acutely following this stuff, or, following their favorite podcasts, the crackpots here and stuff, they're oblivious to what's really happening. And, again, like I'm getting more excited here by the minute talking about it because
You got me excited for future episodes now.
Before you get
the
all
sleepy
lathered up,
summer is over. It's coming back next week.
before you get all lathered up, which is, I think Steve mentioned a really good point, which is like, why don't you just issue more paper at the short end of the curve? And ultimately, I think, yeah, you could probably get away with that for a little while, but you're not solving the fundamental issue, which is bad productivity, rising inflation, too much debt, and higher interest payments.
Can it be solved is the real question.
You can, but no one wants to do the thing that will solve the thing, which is
So
to
if they
run
own
a balanced budget for 5 fucking seconds.
So if they do that, let's say they only issue short end of the curve.
Yep.
And the Bank of Canada or the Fed or your favorite central banker, they anchor short-term rates down there. Now the rest of the curve is exposed. And who borrows at the rest of the curve?
Insurance company, banks,
Yeah,
people.
Everyone, households, your mortgage rate, Steve, your credit spreads blow out. If people aren't happy with a 5% mortgage today, they ain't gonna be happy with a 15% mortgage.
Yeah.
And that's why there's no easy fix to this. If there was, it would have been resolved a long time ago. So it's...
Well, I mean, there's a counter argument to this, which is, people argue that Canada does have a lot more fiscal room than other countries. We often hear, oh, the federal government debt is very low relative to GDP when you compare it to other countries. The problem I have with that is that it assumes that the provinces wouldn't get affected by a blowout in spreads, for example. And I've made the case, and I will make the case continue, that ultimately splitting out provinces and the Fed, I think, is kind of it's a red herring. It's a misnomer. It's a distraction, because ultimately, like we saw during COVID, if the provinces can't borrow, then the federal government's going to have to, in one way or another, basically step in, whether they do it from the central bank perspective with QE, or they literally say, okay, we're going to bail out Nova Scotia or Newfoundland or PEI, whatever it is. And so to split those out, it's a little bit of funny business in my view.
Well, we'll be keeping a close eye on it. Keith's got everyone revved up here for post Labor Day. So hopefully everyone that's listening to this show enjoys a great Labor Day long weekend. The end of summer, but entering into the fall. Great time of the year, getting closer to Habs hockey and financial markets revving higher. Rich might be on the Canadiens tryout squad this year.
Yeah.
And as always, guys, we appreciate the support. See you next week.